Let's get talking now. The Monetary Policy Committee of the Central Bank of Nigeria, in its just concluded meeting for the years, unanimously agreed to retain the country's monetary policy rate at 11.5% for the opt-in time, hereby leaving other key parameters unchanged. According to the governor of the Apex Bank, Mr. Godwin Emefiele, the decision by the committee to retain the 18-month-old 11.5% benchmark lending rate is as a result of the rising energy cost, monetary normalization across the globe, the possibility of slowing growth, and rising concerns over inflationary pressure. This development, the committee believes, will help to continue to support economic recovery until downside risk to growth improves and upside risk to inflation decimates substantially. Well, let's listen to the remarks by the CBN governor after the meeting in Abuja yesterday.
MPC voted 1. to retain MPR at 11.5%, 2. retain the asymmetric corridor of plus 100 and minus 700 basis points around the MPR, and 3. retain CR at 27.5%, and 4. retain the liquidity ratio at 30%. If there's any kind of intervention that we can provide to help it make it easy for them to bring in these products so that this shortage can stop. If agricultural output in our various products are improved, what you will find is that we would see a further moderation in food inflation, which may help to dampen the effect of the rise in core, thereby moderating effectively.
The CBN governor are there, but let's talk about this and of course understand the fundamentals that shaped this decision. I have joining me via Zoom macroeconomic policy analyst, development economist, Professor Ken Ife. Good afternoon, Prof. It's good to have you on the show.
Hi, good afternoon. Thank you for having me.
Prof, I'll ask you this way. What were you expecting, considering all of the issues on ground, globally, domestically, and of course, all that stares us in the eyes?
I was expecting what you will call precautionary and consistent policy to reign in this meeting of yesterday. There is absolutely no doubt that we have strong global headwinds, particularly around Russia, Ukraine, and the impact of the sanctions, pervasive sanctions, global sanctions against Russia, and all of that will affect oil, will affect gas, will affect so many things. And that notwithstanding, we're also aware of the Federal Reserve Bank in America, where the interest rate has hit 8%, for the highest for over 40 years. And they're going to come down heavily on raising the rates. But that notwithstanding, we have to also look at our domestic situation. Because if you look at our domestic situation, in December, we saw a small uptick in price in inflation. We knew what was the cause. It was the Christmas purchase. Then in January, it came down, predictably. Then February, it went up. And we know the cause. The cause was the petrol, the adulterated petrol. And that had a three-tier effect, because one is the price of gas and petrol and solid fuel all went up. And then the second derivative, the second one is that the cars and the power that is used to generate. So all those cars, the prices went up, energy prices went up. Then the third level was the food carried by those transportation systems, and all of the things carried by them all went up. So when you look at the core inflation index that measures all indicators, excluding food sub-basket index, including farm house prices, all of them rose. And they all rose for this reason I gave you, the three-tier increase caused by petrol. But if you didn't have this, the drop in food price would have brought us down to about 15% inflation, because it was so heavy that it compensated or moderated the heavy increase across all inflation indices. So, and you know why it was? Because you saw the rice pyramid, they were all sent out to be milled and they were pouring onto circulation and other things. So, and the harvest, so they would have pushed down inflation significantly, but for this whole petroleum business. So that's why we had that second uptick now on inflation. So for monetary policy to simply jump up and down because of these tiny rises would send the wrong signal to the industry. So it was good that they calmed down and then let's ride that storm. And then obviously if petrol thing is corrected this month, then you will see a normalization and a return to downward trend in inflation. So definitely somewhere, somehow, we would face that prospect seriously of rise in base rates. And then you can see that some members actually voted for increase in policy rates, two of them, and third also, so they are beginning to feel it. So that argument is beginning to permeate the board. But the fact remains that the CBN has made it very clear that they don't want to sacrifice this economy on frivolities. So we want to defend the economy, diversify the economy, support employment, just as Fed is doing. Fed has two primary, that's the American Federal Reserve Bank, two primary tasks given to them by the Congress. Maintain employment, that is increase, maintain employment, and then also price stability. So here, there's nothing wrong with us doing exactly the same. Let's get our economy under control, diversify the economy, strengthen the economy, support infrastructure, and get employment going. And then find appropriate policy, monetary policy mix that supports this position. So, that's why we need to try and avoid whatever could sacrifice this recovery that we have got. So if a sudden increase a sudden jump in monetary policy rate would have, started them wiping away all the gains that we have made since we got out of recession.
Beautiful. Prof, now let's now look at this interest rate that you talked about, considering the Fed Reserve Bank and of course the Bank of England. Let's look at the impact now basically on our country, particularly on debt servicing and all of that. How does this really hit us hard?
Well, it will. Normally, over 60% of world debt is denominated in dollars. So all of these, our euro, dollar loan and all that, they will all face an increase in the price. So there will be a repricing of these loans abroad, those are dollar denominated loans. So we're going to see increases in those. Then also, we're also going to see more vaporization of portfolio investment and foreign direct investment because they tend to go where they can get higher interest and also where they believe the economy is strongest. In other words, the currency is strongest. So there will be a drop in those two categories of investment into the country without a doubt. But how we respond to them, I think we're going to wait for it to come. We don't want to simply jump the boat. If after all, they were talking about Fed responding in January, from January to March, and then, there we are. So we shouldn't be jumping the gun. Let's wait. Let's begin to see that impact. And there are so many balls in the air right now.
Great stuff, Prof. Let's now look at interventions. The CBN governor harped on the fact that there needs to be steady interventions in all sectors. Of course, we've seen what's been happening with focus on the agri space. And with is something that remains a challenge now, considering what is happening with Ukraine and Russia and Ukraine. Now, what more support do you think can be done to our agricultural space so we can take advantage of this? Is it possible for us to meet up with our wheat demand one way or the other?
Wheat is very problematic because I don't think we're even growing up to 10% of the wheat that we supply, that we import. But I think with the current focus on wheat production, we're going to probably turn the page on wheat production systems, just the way we have acted decisively on rice. So you're going to see that. And much more importantly, Ukraine all that trouble going on in wheat would go up. So when these prices go up globally, it incentivizes us in Nigeria to produce more, and CBN is going to deal decisively with investment in wheat production. And they've identified much of the areas like Obudu, Taraba, Plateau states, the areas which is doing really well. So that's that. But there may well be other areas. You could hear from newspaper presentations today that CBN is looking at how to intervene in the current petroleum saga. Now, the thing is this. I think CBN is mindful of price stability this time around. It's really, really fighting price stability. So whatever it is that tends to undermine price stability, you will probably hear CBN saying something or trying to do something. So you can see that some of the gains are being wiped out by the increases in the price of fuel, and so he's going to be talking. CBN is going to be talking to Nnpc, just as Federal Ministry of Finance is talking to Nnpc to see how we could support them to bring down the price of the rising pressure on petrol prices. So not just the occasion by this adulterated fuel. So if it means importing more fuel, bringing money to import a lot more, to increase the strategic reserve for PMS, then that's a good idea. So we will be looking. So wherever there is the possibility that the price stability could be at risk, then you're very likely to draw in the CBN into this, because they want to protect the price mechanism and also want to improve and bring down inflation. And don't forget that price stability is not just inflation. It also involves forex prices. It involves interest rates and money, all those things. They're all rates. All these rates are prices.
Prof, let's talk about Nnpc, which you just mentioned. And already they are telling the Federal Allocation Committee that our proceeds for this month, or whatever we're going to contribute for you to share, will be reduced. Obviously, because they need to pay more for subsidy. The price of crude is so much on the high side. And now the CBN, I want to think that CBN is almost getting overwhelmed with almost all of the sectors. But what do you think? The issue of deregulation pops in again. What is your take with regards to this? Because the PMS issue needs to be addressed once and for all.
The Petroleum Industry Bill Act has directed that we should liberalize the PMS, because we've already done that for kerosene and diesel, all the other products. So it is a necessary end, and we have to move to that end. The issue is how we get there, how soon we get there. And we know the structural constraints holding us back, that the capacities we have in government refineries are not being realized. And then you're going to ask the question, why do you not borrow to revive those refineries so that they can stop the hemorrhage on the subsidy, the hemorrhage by the subsidies? The second question is this: if you are going to spend 3 trillion naira subsidizing PMS, why don't we lend that 3 trillion or half of it to modular refineries to kick in? Look, one modular refinery will cost you about 35 billion naira, doing 20,000 barrels a day. So instead of burning that money irretrievably, you can loan that money to them and they'll repay the money back, and then they will stop you from having to import. It's just simple. And I still don't understand the logic, and nobody wants to think about that. And those people who want to do it are just asking for the loan for them to do it. And there are some that have the money. For example, oil marketers. If you say to oil marketers, you will not be allowed to lift oil or lift PMS unless you actually show me where you are refining crude in Nigeria. This was exactly the same backward integration agenda Obasanjo did to get the cement to where we are, to a net exporter of cement. And I don't know why we don't have the courage to look at that. Those are the things, because of the political economy involved. And the second and third thing really
Prof, before I let you go, Prof, I'm looking at projections already made by IMF for the likes of 2022 and 2023. That's talking about global output growth. It's put at 4.4% and 3.8% respectively. That's for 2022, 4.4, 2023, 3.8. But I'm just looking at all of these issues that we're considering. Do you see this being revised downwards one way or the other, considering the realities that we face?
It's definitely going to be revised down, without a doubt. It is going to be revised significantly down, because the supply constraints you are seeing now with all these embargoes are going to mean a lot of cost to the industry, and it's going to mean a lot of unemployment. It's going to cost a lot of disinvestment. So there will be a downward revision of those forecasts. But whether they would have
Professor Nnpc there. All right, we'll see if we can reconnect with Professor Nnpc to wrap up this conversation. Yeah, I think we'll try to. Anyway, we've heard a lot already from Professor Nnpc there, trying to break down some aspects of the. Okay, Prof.
Yeah, I'm listening.
Yes, please. You were making your point. We had some issues with the audio. Maybe you just do a recap. Just 1 minute.
Yeah, what I was saying is that the global forecast will come down without a doubt.
Good.
It's not because the action involves most of the countries. So you're going to have massive disruption of trade, and it's going to affect the financial sector. It's going to affect the trade. So every sector, even metals, oil, crude, all of them are going to be affected. So you're either receiving less or importing less or exporting less. And that's what's going to happen. So the whole global economy will see a drop, significant drop in the projections for 2022 and 2023. But Nigeria is a slightly different story, because while oil could affect us, you've seen the price. The price has gone up to $130 per barrel. So we're actually getting higher price. So that may even increase our GDP by and large. But the projections on our economy are going to still stack up. CBN projecting 3.2%, 24%, federal government projecting 4.2%, IMF and World Bank 2.6, 2.7. I think we probably will finish at around 3.6, right there about 3.5, 3.6. So it will still be marginally higher than what we had this year, or maybe around the same, but not anything near the global collapse on the GDP figures. I think we will hold up, because there are so many things going on now in the country. We have the Strategic Revenue Mobilization Initiative, bringing in much more revenue and the ability to resolve. Then we have infrastructure company coming in on stream to raise money from the capital market to go more into infrastructure. We have so many things work in progress. And obviously, like the wheat now, we are going to be attacking wheat. So we're not going to suffer a huge rise in the price of wheat because we are going to be growing our own wheat and do it the 2 seasons and all of that, and get into the dams now. They're looking at the dams to reticulate some of the irrigation systems. So, by and large, we'll probably be ready to do better than we have done while everybody else is taking a hit.
I must thank you so much, macroeconomic analyst, policy analyst, and of course, development economist. Prof, always been there for us, Professor Ken Ife. Thank you and do enjoy the rest of your day.
Thank you. Thank you very much.